The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's move on then to discuss the Federal Reserve and the US dollar. Now, just before I move into this, I've chosen the Federal Reserve because it's so significant in the treasury markets and in pricing its own currency, or influencing the price, I should say, of its own currency. However, I want to make clear that this is the function of all domestic central banks, and domestic bond markets, you can apply this logic to each individual central bank, okay, and its accompanying currency. So let's move forward. With the US dollar specifically, we'll go through, of course, some of the historical points. The Federal Reserve is the primary US monetary institution responsible for monetary and fiscal policy and controlling the US dollar money supply. Now, does that make sense? Of course, in control of the US dollar money supply. Well, if we're in control of the dollar supply, of course, then doesn't that mean we have an impact on price, supply of money? Absolutely it doesn't. And how it does this is really by flooding the bond markets with new capital, which we'll discuss. So during the gold standard, the central banks, of whom were signatories to the Bretton Woods Agreement, could bring their gold, literally bring the gold to the Federal Reserve in exchange for dollars. Okay, the dollar came off the gold standard during President Nixon's administration in 1971. Moving away from gold, the United States instituted what is known now still as the petrodollar, where dollar demand was created not because it was backed by gold, but because all countries would need to trade oil in US dollars. And that was a political piece of discord with many nations, of course, but financially engineered with Saudi Arabia and some local OPEC countries there. Okay, so it caused some discord, but now for the last, well, relatively quite a long time now, the last 80 years, we're trading oil in dollars. In recent times, the Federal Reserve inevitably decided to try to print its way out of the financial crisis, whereby the Fed would issue and buy billions of dollars in treasury bonds. Okay, so we'll just go through this last point again. We're going through the cycle of the Fed here. In recent times, we're aware of the financial crisis. The Federal Reserve inevitably decided to try to print its way out of the financial crisis, whereby the Fed would issue and buy billions of dollars in treasury bonds. Now, can anyone think what this is called? What is this coin, this policy here? It was introduced by the Bank of Japan. We have many of our students hitting the nail on the head there. Perfect. Absolutely, guys. Monetary policy. This is the monetary policy of, this is the monetary policy of quantitative easing. So effectively flooding the market with fresh capital, exchanging poor debt, rotten debt perhaps, with healthy fresh cash for other banks to re-stimulate the economy, to create lending, to increase jobs, and vice versa, to continue on. Now, this last point here, in recent times, from the Federal Reserve, with the financial crisis increasing the bond market supply, caused some concern again with the global economy. Really, well, because it undermined those countries who had built up hard-earned positions in US Treasury markets. Okay, so they wanted the return on the markets. They had a price that they got into effectively buying these US dollar-denominated treasuries. This is why China, again, quote unquote, for the world, it called for the world to de-Americanize, as they said. I think it was, as they felt it doesn't really make sense for the world to use dollars at the hands of the Fed self-monetary policy, whereby they can necessarily self-deal their own bonds in their own financial system. But that has global effects. Okay, so you can see what I'm getting at, guys. It's inevitably, if you're able to affect your own money supply by the treasury markets, by bond influence, you're effectively very, very directly able to conflict with the financial markets itself. Okay, and these are supposed to be free markets that we trade in terms of currency pricing. Okay, so let's go on to actually discussing this in a little detail. Foreign holders of US dollars. Okay, now it's quite interesting. This fascinates me particularly here when we see this is all dated there to February 2017, so this is very recent indeed. It does it on to February 2018, our most relative price there, and I'll just highlight that. Our first most extensive holder, of course, of major US dollar denominated debt is China, mainland China, of course. Now that holds a qualitative 176 billion in US dollars of again, at the bottom you can see of treasury bills, T-bonds and notes. Okay, so US debt. If you want to invest in dollars, that's how you do it, guys. So the bond markets or the treasury markets are so significant for the financial investment community. They offer a return on investment. That is effectively how you do it, and we'll discuss this in detail. So what you could do as a level of interest, guys, is, well, we can see, where our own country is, of course, in this little chart here. We've got Japan second there, and you can see the difference, holding quite a lot of 1,059.5 billion. And actually Ireland are third there, my home country here. We can see a relative point there, February 2018, we are holding 314 billion US dollars of denominated US Treasury or T-bonds, okay, or notes. So quite a lot of debt that we are holding, US debt. And again, we are at risk if there is going to be a default from the American government. That is not the case, of course. They like to roll over their debt on an annual basis, of course, and are, in terms of financial markets, are considered to be quite risk-free in terms of default risk. But you can see the level of debt out there in the markets, just from one country to the global landscape there. A huge amount of debt, totaling at the bottom here you can see for official total 6,291 grand total of debt outstanding there, billion in US dollars treasuries. Okay, so quite significant. You can see if there's going to be a huge shift in demand or a new price created by that supply and demand shift, of course, there's going to be ramifications globally. And this, of course, is some rhetoric in terms of China, Russia, these countries. They have often threatened to literally sink the US Treasury market by selling their bonds back into the secondary market. So let's move on again and we can discuss this. Well, what happens if foreign investors reduce their need for US dollars and treasuries? Okay, so we're trying to tie in, why this is so significant for Forex traders. Why is, why is it so significant, those holders of US treasuries? How does that create demand for the currency itself, for dollar currencies? Again, if you're looking to discuss demand for euro demand, well, you can look at the associated bond market, which is the 10-year German durated bond. You can look at the BTP, which is the 10-year Italian bond. You can look at the FOT, which is the French 10-year bond as well. So again, there are many, many different assets you can look to trade, and again, they all value or have an intrinsic value on pricing the euro currency itself. So again, what happens if foreign investors reduce their need for US dollars and treasuries? There will inevitably be less demand for the dollar. Okay, so they're reducing the amount. Let's say Ireland had 309 billion in treasuries there in US treasury. We bring that down to 200 billion. We sell 100 billion back into the market over the next 6 months. We don't want them. Okay, so we're effectively selling that back into the market, and that is going to create a level of dollar depreciation. Okay, selling dollars effectively as opposed to buying or creating demand for them. Dollar denominated assets will become cheaper to buy, of course. Okay, so we see dollar depreciation, then those dollar denominated assets will become cheaper to buy. So your American equities, perhaps the equity markets, oil might see a little bump being priced in US dollars as well. The US government will further struggle to meet its financial running obligations, and again, that is the reason why the governments sell bonds, of course, to meet their own financial obligations. Those countries who held a substantial amount of US treasuries will see an appreciative lift in their own currencies. Okay, so why might that be the case? Well, again, we'll use the Irish example. Because we are effectively selling that back into the market, we're cashing out our dollars for our euros here in Ireland, and effectively we may see a lift in our own currency. Okay, so many factors there, of course, and one of the main factors when we are discussing how to price currencies, of course, is interest rates. Now, I really want to spend some time, and I'll give you a few examples with this, simply because this is so prevalent, guys. This is so prevalent for us trading these markets over the next 3 years. Why do I say that? Guys, we've just come off a long period of quantitative easing in Europe, in the US, and in other countries, of course. What we are now seeing is we are starting to look for rhetoric from Mario Draghi, the president of the ECB, when we are starting to come off monetary easing, when we're going to see evidential interest rate increases. And of course, we have seen that in many countries there. We've seen them a couple of times there in the US. We have seen them quite a few times there again in Canada, and now we're looking more closer to home with the UK. So interest rates themselves, international capital flows seek the highest inflation adjusted returns, creating additional demand for high real interest rate currencies and pushing up the rates of exchange. So I hope that makes sense. It's quite constructive, it's quite clear. So we're creating additional demand for high real interest rate currencies. Okay, the interest rates are seeking a higher level of attractiveness, of course, for those investments, of course, and they're going to see flows of capital move in. Money will flow to wherever it can get the highest return with the least risk. If a nation's financial instruments, such as stocks and bonds, offer relatively high rates of return at relatively low risk, well, foreign investors will demand, so they will demand its currency to invest in them. Okay, so very significant there. So let's just go through an example here, a real example for us to look to trade. Okay, interest rates. Okay, well, how can it actually fundamentally affect us? Okay, we'll use a local banking, we'll use a local domestic deposit account to use as an example here. Well, effectively, an increase in UK interest rates is what we see. We're going to see a better return on UK savings account. Okay, so those banks, that's going to trickle down from the central bank into the local banking economy. It's going to offer better returns on UK savings accounts. Capital flows into take advantage of higher rates. Okay, so there's going to be capital flows from other nations into our banking system, given the higher rates they offer. And an increase in demand for pound sterling is of course seen. What we then see is an appreciation in the value of sterling. Okay, so an appreciation in the value of sterling is our effect. Okay, so let's move on then. What we're actually going to discuss now is an expectation factor. Okay, so an expectation factor in looking to actually price in some of these moves. So just have a look at these two charts and see if you can spot something. Okay, we have an expectation, strong data. Okay, we have some strong data. I'll give you a clue. This is in the UK. Markets are pricing in a May interest rate increase during the month of May. Okay, so just have a look at that chart and we'll see if we can spot a possible trade opportunity. Okay, so what we see here, guys, evidently what we're seeing is some very sharp moves in two markets. So what we have in front is, of course, our now it might be a little small on screen to see, so I'll just point this out. The screen on the left here, this is actually the cable market. So this is pound US dollar. And here we have sterling against the Japanese yen. Okay, so there are two markets of question. What we evidently see is two very strong moves in these markets. Okay, Now, the expectation there in May was, of course, on a very clear interest rate rise. Okay, a very, very clear interest rate rise. And effectively, what we see then is the markets should not bet on a May rate, says Mark Carney. Okay, so effectively, he's communicated to the markets through his statements that I don't know why the markets are pricing this in, guys. We're not ready. The economic data is strong, but still a little soft in some areas. And effectively, what happens is, well, we see two very technical breaks. This is exactly at the level, guys, exactly at the level where Mark Carney came out and said, well, guys, the market seemed to be certainly pricing in a May interest rate increase. There evidently was no interest rate increase in May, and these markets traded down. Sterling became a lot weaker and effectively broke long-term levels. Not just in one market. Again, I wanted to show you several markets where it broke against the yen and the US dollar. So very, very significant for us as traders there, guys. The effect, sterling depreciation. Sterling depreciation is, of course, our effect there. So let's move across then and let's discuss how we start to factor in pricing currencies again. And again, I want to take it back to the Federal Reserve and the US dollar. So, I mean, this is how we effectively look to price the markets. Considering now that the United States has such a high level of deficit spending, there's a real fear of large foreign investors selling off US Treasury bonds. Why might that be the case? Well, let's look at, and this is going to tie in quite a few things. It's going to tie in interest rates, inflation, and it's going to tie in the debt markets themselves, the bond markets. Okay, so stay with me here. Right on screen here we have what we call T-bills. Now they are bonds from 1 month to 1 year. We have treasury notes, which are often from 1 year to 10 years, and then we have from 10 years onwards to 30 years and up, of course, treasury bonds or T-bonds. So there are effectively different levels of debt that you can look for in the US economy. And up on top here, I'll just point this out. This is effectively what we have here in terms of the these are known as the yield prices, okay, or the yield spots. Basically, all this means is that these are the levels of return that we're looking to actually. Sorry, these are the levels of return the U.S. government is applying for its duration over its debt markets. Okay, so we'll walk through what we try and see here, and we're actually going to outline what we call the yield curve. So here we have our points here. Our 1 month is just right at this market there. Our 2 month, again, I'll just point these out here. We're effectively just these prices here. Okay, 3 month, again, just in around here. And as we move across the data, we'll plot some points here. We have our 1 year. We have our 5 year interest rate. What is the 5 year interest rate there? 2.58. Okay. So 2.58% of an interest rate on a 5 year bond. Then we have our 10 year, which is 2.77. At 20 years, moving up, then we have 2.89 and 3.01 respectively. That's effectively what we're seeing, guys. Okay, that's effectively what we're seeing across the spectrum, the debt spectrum. Now, let's just draw and plot a line here, because what this identifies to us, guys, very simply, we know this as the yield curve. Okay, this is called the US yield curve, and it's effectively the curve over debt for the US bond markets. Okay, now I'm just going to put in a rough guideline here to what we see in Germany at the moment. So not as attractive, guys. Okay, not as attractive. You can see for the amount of interest, I'll just pull that back. For the amount of interest received, you're actually, investing the same amount of money for the same amount of time. But again, it's not giving you the same amount of interest. The interest level is much higher in the US than the German bonds, okay, the German debt market. So you can see why that is much more attractive, of course, and what that leads to as this increases, as this yield curve, increases in terms of its interest rate, or what we would call inverts. What you would effectively see are the dots starting to line up in a much more constructed fashion. And let's say we get them over and above here like this, well, of course, that's going to be much more attractive, and that is a big yes for markets. That's effectively what we're seeing now. We have the 10-year now, guys, at 3%, 3.1%, just here. So that is effectively where we're at now, the US 10-year. So you can see how attractive that is in relation to German debt instruments, okay? So that is effectively going to be more attractive. That is going to lead to a large increase of capital flight moving towards the dollar, okay? That is effectively, if you're looking to invest in dollars, well, what return do you get in dollar investments? Just in cash, of course. You look to you look as your barometer for the debt markets to point that out to you. It is much more attractive. You're going to see a rise, an increase in demand for dollars given its attractiveness, okay, in relation to other currency pairs. So that is one fascinating factor that the bond markets has. That is how the Federal Reserve, that is how the central banks of the world use and manipulate the bond markets to effectively change their currency, to use interest rates to change the bond market structure, and to use interest rates, of course, to hopefully maintain inflation with their policy mandate of 2%. Okay, but you can see how all this factors in an overall stifling, hampering, or positive effect for an appreciating or depreciating currency. Now let's move on then to another fascinating spectacle here. Another fascinating point in the currency markets. We call these commodity currencies, okay? There are very notable relationships for some currencies to commodity sector as a whole. Many economies, most notably Canada and Australia, are relying heavily as a function of international trade on commodity prices such as oil, copper, and zinc. Now, what we have here in front is a very fascinating chart. I'll just bring your attention to it. So I've actually done an outlay of two markets here. Now you should be able to see this on screen here. We have the US oil, and then we have in blue the US dollar against the Canadian dollar. Now the first thing I'd just like to bring your attention to, and like you to bear in mind, how are these Forex pairs, how are Forex pairs effectively priced? How are they quoted? You know, it's quite basic. We would have done this through many of the beginner education here. We have, of course, US dollar against a Canadian dollar here, okay? So this is the Canadian dollar here. So this is our base currency, our quote currency. And effectively, when we see dollar strength, we see this move to the upside. When we see Canadian strength over the dollar, we see the markets move to the downside, okay? So I want to show you here how important this relationship is with the Canadian dollar. Again, remember again that, well, the oil market should be a constant factor because the US economy relies on the oil price as well. The US economy is one of the biggest importers and exporter of the commodity, but it's not as significant in terms of the function of the economy as the Canadian economy. And of course, it relies heavily in terms of its capital flow in that single commodity. So let's just bring your attention to how significant this is, guys. And this is simply, I've just done this with relative price action off. And what I've done is actually just include, this is the same date across the bottom, okay? So this is effectively the same date for both across the bottom. And the same price here, we have the oil price here. If you can just see in black, we have 74.60 or 74.80 there on top, and again the whole way down to our 26.65. And again we have the corresponding currency price there against the dollar. Okay, so just to draw on screen yet again our US dollar against our Canadian dollar. So when we see times of Canadian dollar strength, guys, what are we likely to see? When we see Canadian dollar strength, we are likely to see the oil market moving up, of course. So I'll pick a point here when we see the oil market. Let's just pick a point when we see the oil market moving down. So a very weak point. We're here at the oil market around $59, okay? Right here at point 1. Then we see a very, very sharp trend to the downside to very, very strong relative lows here, okay? This is the low 8th of February 2016, guys. 26, just over the 26 bucks, okay? So again, this is our point 2. Okay, so you can see the differential between the Canadian price. Again, this is not showing dollar strength, okay? Oh, sorry, excuse me. This is showing, of course, dollar strength over Canadian weakness. The Canadian dollar is, of course, very weak at this moment in time. Why? Because the oil price is very weak at this moment of time. Look where the oil price is. So weak. And that is such a strong correlation, guys. You can see the differentials. If I take away on screen here, we see, dollar strength. I'll just move this away. Sorry. What we see here, again, we're seeing effectively when the market trades up in this market. This is the oil market right here. Look at the differential again. We're seeing Canadian strength against the dollar, so the market is trading down. Okay, we're seeing again the market consistently trade in a range, so it starts to stabilize. Again, when we see more differentials, we see the oil price at highs, we see Canadian dollar strength. We see the oil price at lows, we see US dollar strength over Canadian dollar weakness. Okay, so it's so significant, this single relationship with the Canadian dollar. And guys, these commodity currencies, when you're trading the Aussie dollar and you're trading the Canadian dollar, you should always factor in if there's very strong movement in the oil price as well. So that brings us on into discussing risk associated currencies with safe haven flows. Okay, so now the term itself, safe haven flows, refers to the flow of capital into safe haven currencies. Safe haven currencies are currencies deemed by investors to be low risk, and so in times of uncertainty, investors feel it prudent to move capital out of higher yielding, higher risk currencies and assets and back into lower yielding but lower risk currencies to protect their capital. Now, does that make sense? Of course, it's all about risk, guys. A lot of these trades are all about risk. We know that the Japanese yen is one of our most common barometers of risk. When we see market uncertainty, we see cash flow into the Japanese economy. It's a strong economy. It's healthy. The Japanese currency sees an uptick. Countries with strong economies are deemed the safest place to store capital in times of economic uncertainty, as there is lower likelihood of these currencies suffering acute devaluations amid market turmoil. So quite straightforward. Aside from having a robust economy, characteristics of these safe haven currencies and countries include stable political landscape and high liquidity. Okay, so your ability to get the money in and out of the nation. So we mentioned Japan there. Japan sees strong safe haven inflows in times of global uncertainty due to its large amount of foreign investment. When risks are perceived, investors repatriate their capital from those chosen countries of an investment and convert it back into their native yen, buying Japanese government bonds. Okay, again, a lot of this is done, guys. You don't simply go to buy billions of dollars of currency. You go to the bond markets, guys, and that is where you do your business if you're a large institutional or a local government. Switzerland, again, its historical position of political neutrality has made it a popular safe haven destination for concerned capital holders. However, the popularity of this currency has seen appreciate greatly in recent years, with the Swiss National Bank having to reinforce a currency peg with the franc and the euro in 2011 to stop it appreciating anymore. Do we remember that, guys? So do you remember that? Again, we've seen the Swiss National Bank make efforts where it's currency, given its trade surplus, it's such a strong currency, it's hard to see it not appreciate over the long run, and they often step into the bond markets to change this. So that brings us to the lesson summary. I do realize there's a lot to take in during that lesson. What did we learn more specifically in today's lesson? Practical currency trading is all about trading strength versus weakness. There are an unquantifiable amount of factors that can cause currency volatility. The market often prices in expectations of economic performance before expectations are realized, and this often causes great volatility and opportunities in currency markets. Exposure can be gained in trading unorthodox currencies such as the South African rand, the Russian ruble, and the Singapore dollar as well. There's quite a few of them out there. The Hungarian forint, we discussed the Turkish lira, quite a few of them out there that you can look for opportunity in, guys. So well done, congratulations. We have now finished webinar 12 of your Become a Pro course. So look guys, thank you very much for joining us. I'll let you go for the weekend. Of course, we'll be back Monday with lesson number 13. So from all of us here at Forex.Academy, thank you very much for joining us. We'll see you next time. Bye for now.